welcome to ICICIdirect. Joining us today on the show is Tejas Kadam, Vice President PMS, to talk to us about smart beta strategies. Tejas, markets are extremely volatile. We've seen that in the last couple of months, not just locally, but internationally as well. Of course, the nature of the market is such that the focus is now moving to a lot of passive and passive plus strategies. ICICI Securities PMS, I believe, has launched a few smart beta strategies. And I understand you are ramping up further in this space. Before we talk about product specific, can you first tell us what is this new style of investment called smart beta?
Thank you, Samina, for having me here. It's an absolute pleasure speaking with you. You're absolutely right. ICICI Securities has already launched a few smart beta or factor strategies, and we've got big plans to kind of launch a few more. So we're going to have a large suite of strategies by the end of the year, hopefully in the next coming months itself. To answer your question on is it a new way of investing, I'll answer that with a yes and a no. A yes, because for Indian investors, for the Indian markets, it's a new concept, not something that's been here for a very long time. We, in fact, were one of the very first players to come out with a smart beta strategy about 3 years ago, and today there's been a proliferation of such strategies. I'll also answer that with a no, because while it may be new for us, Indian investors, it's a well-tried and tested, well-adopted strategy in the US and the UK and some of the other developed markets. So now to talk to you more about why the no, I'm going to take you down a timeline, a history lap. But before I do that, let's see where we fit smart beta exactly. So historically, investors have always thought about equity investing in, like, say, a binary approach. It's either an active or a passive. Active is where a fund manager has a view about what the markets are going to do and then takes positions accordingly. Passive, on the other hand, is where you get the returns of a benchmark, an ETF, an index fund that gives you the return of, say, a Nifty 50, a Next 50, the Mid-Cap 50, and so on and so forth. Smart beta sits exactly in between the two. And this may be a cliche term, but true, it takes the best of both worlds. So smart beta, in its benefits, take the outperformance or the alpha seeking ability of the active investors, but at the same time, they're rules-based, transparent, and cost-efficient, similar to the passive strategies. Now let's go down the history lane a little bit to see where exactly did these start. So smart beta or factor investing is an academic concept. It was, what I mean by that was, it wasn't the Wall Street guys who came up with smart beta. Rather, smart beta was discovered within the universities and the colleges. So academicians going back so many years have been working on such strategies. In fact, the very first instance of smart beta or value investing within smart beta was started by Graham and Dodd back in 1934. That's close to a century ago. Also, the first public product on smart beta was launched in the US in the year 2003. So US has seen a 20-year history for such products. Today, if you only look at the public products that are there, not even look at the private accounts or the segregated accounts like the PMS ones, there are currently $1.3 trillion managed to just smart beta strategies. To put that into perspective, that's more than a crore rupees. So that's a huge amount of money that's managed to smart beta strategies. And because it's academics, there have been a lot of papers written, which then get evaluated. And smart beta related strategies today have earned close to 6 Nobel Prizes. So if I had to summarize what smart beta really is, it's alpha seeking, rules-based, transparent, cost-effective, a crore worth of assets managed, a century worth of history, 2 decades worth of life track record, and 6 Nobel Prizes. That's how I would summarize smart beta today.
Very correct, Tejas. In fact, the fact that the active fund managers have struggled in the recent past, at least in the large cap space, to outperform passive or passive plus strategies is probably the big trigger for a lot of these products getting launched. This is also relatively cost effective because given the lack of human intervention, unlike active fund management, this becomes a fairly popular product. Can you tell us a little bit more about the factors that are used in these products? I know a lot of it is AI.
Yeah, I think yes and no again. I'll come to the AI part later on, but talking specifically about the factors, as I said, it's come out of academia. So when there is so much research going on, there are a lot of papers published, and a bad byproduct of it rather is that there are too many conclusions out there as well. One firm, when evaluating smart beta, once said that there are close to 300 factors out there. Unfortunately, most of these factors fail the acid test. Now, what's an acid test or what makes a factor is something that requires a much deeper discussion and maybe for another day. But for now, let's stick to the factors that we think are factors and are also broadly agreed upon by the investment community. There are four primary factors that we think of. One is momentum, which is trend following. Second is quality, which is buy stable compounders, quality companies. The third is low volatility, which says that less volatile or less risky stocks tend to outperform their risky counterparts. And the fourth is value, which is, as everyone knows, buy low and sell high. There are two other factors which people talk about a lot. One is the size factor, so mid caps or small caps doing better than large caps. While this is true, we don't think of it as a factor. We rather incorporate that in our other factors. And the sixth is dividend yield. So dividend yield is also considered to be a factor, which we don't really consider it as a factor. We're rather going to use that as a trade for some of the securities in our products. So to summarize, from our perspective, we look at four factors: momentum, quality, low volatility, and value.
Right. They just briefly tell us, why do these factors work and why should investors be taking notice of them?
Sure, absolutely. So the reason why any factor would work is very, very logical, very, very reasonable. And there can be only three reasons. One, it's a reward for the risk that you're taking. Two, there is a behavioral bias or a behavioral inefficiency. And three, there is a market inefficiency that the factor exploits. So let's look at the factors one by one. Let's take the most popular ones, the value and quality, which most people are familiar with. These are both a reward for the risk that you're taking. So quality is what, with all due respect to my parents, quality is what I call mom and pop stocks. These are stocks that have been there for a very long time, stable companies, consistent compounders. These aren't glamour stocks. You wouldn't hear about them like every month, every day. But when you take a much longer horizon, say 10 years, these are the consistent compounders, the stable companies that constantly keep doing well. Value is fairly simple. It's buy low, sell high. So buy companies that are priced at a value that's much, much lesser than their intrinsic value. So those are the simpler ones. Right. Next, let's talk about momentum. This is the behavioral bias. Now, momentum is all about chasing glamour stocks. When we look at markets or when we read about markets, we often go to the media, we often look at news channels. There are always those glamour stocks that everyone's talking about, stocks that have done 2x or 3x or 5x in the last 6 months and 1 year. These are the stocks that your colleagues talk to you about, your friends talk to you about, your uncles and aunties are talking to you about, and you're worried about missing the bus. So you jump on the bandwagon and buy into those stocks again. Now, these stocks which have done well, just because everyone's kind of buying into those stocks again because they don't want to miss the bus, continue to do well over a reasonable period. And momentum tends to exploit exactly this. This is a behavioral bias factor. And the last, which for me is the most interesting, is the low volatility factor, which exists because of market inefficiencies. Now, low volatility as a factor is confusing because we've always read, like, if you're taking high risk, you should get high returns. If you're taking low risk, you should get low returns. Right. But what we've noticed is the low risk stocks tend to outperform their high risk counterparts by a significant margin. So let's try to understand why. And this is a market inefficiency. Now, most people have a larger risk appetite, They're okay to take more risk to get that higher return, and which is why. But oftentimes there aren't so many opportunities to take those high risks, which is why to get that lottery effect, where if I take high risk, I get a much higher return. I'll put all my money into a very risky stock, hoping for that stock to go up significantly, and then I can already see my yacht, my beach house, and which is why people tend to invest into these companies a lot more than what they should. They look at those high risk, high beta stocks, which make them very, very overpriced. It's not just me who's looking at my yacht. Everyone around me sees their yacht along with it. And which is why these companies tend to get inflated to an extent where it doesn't sustain anymore. And which is why low vol companies tend to have a much smoother ride, especially when those high beta stocks tank and bring your value down. Now, the first question that can come to everyone's mind is, these four explanations seem pretty logical. They're reasonable. I know that at the back of my head. Like, this happens all the time. Why is smart beta any special? And to explain this, let me give you an example that was quoted by one of the persons that I follow a lot. His name is Andrew Ang. He was a professor at Columbia University in the US for 20 years and now heads the smart beta team in BlackRock. He compared it to a smartphone. So I'm sure you've used your smartphone about 200 times since the day began. I've used it about 400 times since my day began. But if you look at your smartphone, there's not really a lot of new things in your smartphone. If you go back 20 years, you still had maps. You could book hotels. You could book flights. You could order food. You could even make phone calls. So the smartphone isn't really giving you a lot of new things. What it's doing is it brought all of them together in one device and made it very easy for you to use. Smart beta does something very, very similar. It brought a lot of these ideas which existed outside in a very simple, rules-based manner, and then offered it at a very cost-effective price in a very simple format.
Right. That's a very interesting comparison. I'm guessing a lot of our viewers could probably relate to that. Tejas, is there any specific niche of investors that these strategies work best for? Or is this a strategy for everyone? Also, what are the risks that investors should be aware of while investing in these strategies?
Yeah, of course. So if you ask me as a investment manager, I would say it's a strategy for everyone, and everyone sees these strategies differently. Whenever there's something new, there's always a fear of whether I should go into it or not. But if you understand these strategies well, this is absolutely a strategy for you, and it's my job to make it clearer for you. But that said, like it's a strategy that appeals to different people in different ways. Some investors who are already allocated to a lot of fundamental managers see these strategies as a diversification tool because they've already invested into multiple, say, growth managers, and these strategies perform slightly differently and in different cycles. So this can be a good complement, a good diversification. For other investors who believe in the power of data, who believe in the power of computing, these strategies even become the core allocation for some of these products or some of these portfolios. Now, coming to the risks, just like any equity strategy, this has its inherent risks. And the biggest risk is cyclicality. Now, when strategies are being thought through from an academic perspective, oftentimes we tend to look at a 10-year horizon or a 20-year horizon, and we say everything looks good. Like at the end of 10 years, you're getting a very good alpha, you're getting a good premium, you're getting good risk reduction. But then investors don't really live for 10 years through a strategy. They are constantly looking at their portfolios, they're constantly looking at the returns quarter on quarter, year on year. So as investors, are we really able to sync our view with that of academics? Probably not. So if you look at a single factor like low vol, it's bound to do well when markets correct, when markets are flat, choppy. But the minute you hit a bull run, low vol strategies will underperform. A investor who's into low vol will ride through that 1 year of underperformance and say, maybe it's time to change it. Maybe I need to go into something else. And their investors aren't really able to take advantage of the entire up and down movement, which can then subsequently benefit them over the 10-year history. And which is why we at ICICI Securities made a very conscious decision that we will not be doing any single strategies. We will only be doing multi-factor strategies, which combines one or more of these factors together and then presents a much smoother ride to our investors, not just get the absolute alpha at the end of 10 years, but every 6 months or 1 year when the portfolio is being evaluated, you don't panic and try to get out of it. It definitely should be a smoother ride as opposed to just the one observation at the end of 10 years.
Very, very fair point, Tejas. Can you talk to us a little bit more about the products launched by ICICI Securities PMS so far, and any other interesting ones in the pipeline? And how do these products address the risk that you talked about previously?
The first part that I wanted to cover was the products that we've already launched. So like I said, we were one of the very first to even enter the space. So we launched 3 years ago our first product, which is called Active Index, which is a smart combination of alpha and low vol as two factors. Alpha is similar to momentum. We recently launched another product, which is Momentum Quality Dynamic Advantage Portfolio. It's called MQDAP, and as the name suggests, it's a combination of momentum and quality. Now, the beauty about these two products in itself is they address different needs. The first product is geared for investors who are less risk averse but want to participate in bull runs as well. The second product is more risk seeking, or I beg your pardon, it's more return seeking. So it may at sometimes have a risk that's higher than the benchmark, but what it's targeting is the absolute alpha or the absolute outperformance. So these two products in itself also are diversified in their sense. The next two products that we have in the pipeline, A is an enhancement of the first product that we launched, which is the low risk strategy, but with a higher kicker of alpha. And the second product is a more stable all-weather 4-factor strategies, which combines all the 4 factors that we spoke about earlier, momentum, quality, low vol, and value, and then decides on the allocation for each of these factors based on a timing model as well. So this strategy sits right in between the less risk and the high return strategies, where you could kind of stay in this for much longer and get a much smoother ride. The benefit of doing this is we've always wanted to build a platform where we could offer smart beta strategies to different kinds of investors, all of whom are at different risk tolerances. Now, an investor doesn't have to adjust his risk tolerance to get into a smart beta product. We'll create customized products which can tailor to every investor irrespective of their risk tolerance.
Right. Tejas, very lastly, you mentioned that this is a strategy that is also adopted by very large clients in developed countries. Do you see this happening? Can you tell us why this strategy is so appealing to the larger sort of families or family offices that matter?
Factor strategies, if you think about it, are merely building blocks. Every factor is a building block, and then you can mix and match these factors in different combinations. For large clients, this is especially important because this can act as a complementary solution. They already have their existing portfolio. They can evaluate their portfolio, look for holes, and then create strategies which can fill those gaps. So for example, we'll always have our flagship products through our DPMS or our standard discretionary PMS offering. But at the same time, we also have a non-discretionary PMS offering or a platform where clients can reach out to us and then have customized portfolios created for them. Let me give you an example. Let's say you as an investor are already invested in the momentum strategy via a public product. You've benefited it during certain years, but there are certain years where you're going to have a tough time because every factor is cyclical. You could come to us and say that I have a momentum strategy, which I think is very choppy. I don't want to get out of that strategy, but can you build something that's complementary? So we could take the other 3 factors and build a strategy for you. So it sort of not only works for those clients which are looking to get into equity and want an off-the-shelf solution, but also those large clients who already have investments but are looking for complementary solutions. a debt investor wanting to get into equity will probably not want to take a large portion in equity because of the risk profile. They can come to us and ask for a much lower volatility strategy, which can make their journey from a debt to equity much, much smoother, a lower risk than just buying a passive fund off the shelf. So because these customizations then or rather help an investor complete their portfolio, this has now become very popular in the West, and especially large offices in India who are evaluating their entire gamut and not just a single portfolio can make great use of these customization tools too.
Right. Thanks a ton, Tejas, for joining us today on the show. It's indeed a pleasure to understand for all of us on the other side of what smart beta strategies are all about and why they're gaining in popularity. ICICI Securities PMS has already launched a few of those strategies, and there's a lot more coming up in the pipeline there. Thanks again for watching. Thank you.
Absolutely. Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.